Hi, I'm Lango, and this is InvestorPlace Quick Picks, where we communicate to you some of the market's best investment ideas in just 5 minutes. Today, we're going to be talking about one of my favorite long-term growth stocks, the name Chegg, ticker CHGG. Now, Chegg Stock has come under some pressure over the past few weeks because the company reported blowout Q3 numbers. Again, they were blowout numbers, super good, beat revenue estimates, beat earnings estimates, beat user estimates, really good numbers. But management issued a 2021 guide that didn't quite live up to expectations. Specifically, it calls for a big slowdown in revenue growth from 2020 to 2021. And the implication, of course, is that as the COVID-19 pandemic passes, as students return to school, demand for an online learning platform like Chegg will fall off. That's what management's guide implies. So investors have been selling Chegg stock. But I don't think that's what's going to happen at all. Instead, I think this e-learning mega trend is going to persist regardless of what the pandemic looks like in 2021, 2022, 2023, because the future of learning is hybrid, and Chegg is turning into the Amazon of this burgeoning market. So buy Chegg stock on this transient weakness, hold it, and let long-term secular tailwinds take this winner way, way, way higher. Now, to be clear, Chegg's third quarter earnings report was actually really good. The company added a ton of subscribers, up 69% year over year. Average revenue per subscriber rose 2%. Service revenues rose 72%. Total revenues rose 64%. The guide calls for most of these robust growth trends to persist into the fourth quarter. So right now, Chegg is firing on all cylinders. The company is absolutely killing it. But Chegg stock sold off because, again, the 2021 guide calls for these super big growth rates to moderate come 2021. But that probably won't happen, so the current weakness in Chegg stock is a great buying opportunity. Now, there's this general feeling out there that Chegg demand has soared in 2020 exclusively because physical schools have closed, and therefore as physical schools reopen in 2021, 2022, Chegg's robust demand drivers will moderate. And I get that argument, I really do. Of course, as schools close, you need an online learning platform. It definitely bolsters the need for Chegg. But schools reopening in 2021 is not going to kill Chegg demand. If anything, it's actually going to help Chegg demand. And that's because if you zoom out, the reality is that the education space was stuck in the Stone Age prior to the COVID-19 pandemic. You had students who were born in the era of Facebook, Snapchat, Spotify, Netflix that were learning from physical textbooks, writing on chalkboards, writing on whiteboards, turning in physical papers. That discrepancy makes no sense. Every aspect of these students' lives had advanced into the modern digital era except for their academic experience, except for the education realm. And COVID-19 has now given that area an opportunity to leapfrog into the modern digital era. And that's exactly what they're doing. Now when schools reopen, we're not gonna go back to what it was like in 2019. We are going to go into a future of hybrid learning, where you have in-class lectures, where you have in-class labs, where you have that physical experience, but it's supplemented by an online virtualized experience, where you have connected learning platforms like Chegg to offer 24/7, always on-demand tutoring, academic help, virtualized student resource center type things. That is here to stay. It is a shift, a paradigm shift in the way we learn, making it easier, more convenient, and ultimately better. So as schools reopen in 2021, that is not a headwind for Chegg. Rather, it is a tailwind because you're going to have more students learning and more students who are going to want to use Chegg as their online learning companion. So as for near-term weakness in Chegg stock because of a bad 2021 guide, well, that guide is going to prove far too pessimistic, and the actual numbers are going to blow those estimates out of the water. So this weakness in Chegg stock, yes, it's transient. And Chegg stock itself is a huge long-term winner because the online education space is in inning 1 of digitizing. There is a long runway ahead. Chegg is the Amazon of this space. They are the leader. They are the biggest brand. They have the most users. They have the most resources. They have the largest value prop. They have the best experience. Now, because of that, they're going to leverage all of those things to sustain leadership in this market as online learning goes from very niche today to ubiquitous by the end of the decade. And through this process, my numbers say that Chegg Stock, it's not going to be at 60, 70, 80, 90. It's going to end up at $200 when all is said and done. So down here, you see the stock selling off around 75. Buy the dip. It's not going to last, and the stock is going to rip way higher over the next 6, 7, 8, 9, 10 years. Well, that's all we have for this edition of InvestorPlace Quick Picks. I hope you like what you saw. If you did, please subscribe, hit the notification bell, smash that like button. And if you'd like to read, come over and visit us at InvestorPlace.com, and we have some of the market's best analysis. Until next time, cheers and happy investing to all.